This LOS is explain the marginal cost of capital's role in determining the net present value of a project. Applying the cost of capital to capital budgeting and security valuation. So now that we know how to calculate the weighted average cost of capital, we need to look how we apply it. So the weighted average cost of capital, or marginal cost of capital, corresponding to the average risk of the company, adjusted appropriately for the risk of a given project, plays a role in capital budgeting decision-making based on the net present value of that project. Recall from the reading on capital budgeting that the net present value is the present value of all the project cash flows. It is useful to think of it as the difference between the present value of the cash inflows discounted at the opportunity cost of capital applicable to the specific project and the present value of the cash outflows discounted using the same opportunity cost of capital. So recall the net present value is the present value of the inflows minus the present value of the outflows. If an investment's NPV is positive, the company should undertake the project. If we choose to use the company's weighted average cost of capital in the calculation of the net present value of a project, we are assuming that the project has the same risk as the average risk project of the company and will have a constant target capital structure throughout the useful life. So continuing with applying the cost of capital to capital budgeting and security valuation, for the analyst, the second key use of the marginal cost of capital is in security valuation using any one of several discounted cash flow valuation models available. For a particular valuation model, if these cash flows are cash flows to the company's suppliers of capital, that is free cash flow to the firm, the analyst uses the weighted average cost of capital of the company in the valuation. If these cash flows are strictly those belonging to the company's owners, such as the free cash flow to equity or dividends, the analyst uses the cost of equity capital to find the present value of these flows. So we're going to learn more about that in the equity valuation. And of course, in CFA Level 2, it's covered in a lot of detail. But we can look at the free cash flows to the firm or the free cash flows to equity, okay? So what they're saying is if I'm looking at free cash flow to the firm in period 1, and I'm going to discount it back, 1 plus R to the 1, that this discount rate is going to be the weighted average cost of capital. But if I'm looking at the free cash flow to equity, so I'm looking at free cash flow to equity in period 1, and I'm discounting back 1 plus R to the 1, that this cost is the cost of equity, okay? And sometimes the required return to equity, sometimes we use the CAPM to do that, which is the risk-free rate plus the beta times the return to the market minus the risk-free rate. Cost of equity, when we're looking at free cash flows to equity, weighted average cost of capital when we're looking at the free cash flows to the firm. And that's the last slide for this LOS. Thank you.